Hi, welcome back to the show. This is your host, Mark Howard, and in today's show, we're going to talk about how to save money as an LLC owner. And you're going to learn some of the basic tax strategies up to some very advanced strategies, and then we're going to go even further and talk about some of the niche tax strategies that are going to be involved. Now, this is for entrepreneurs, this is for small business owners. If you're just a regular employee, you're going to learn a few things as well. So we're going to show you how to put all this together, but the bottom line is by the end of this video, you are going to learn quite a bit of strategies that you can either use on your own or with a tax advisor to really double down and save as much money as possible on taxes. Let's go ahead and dive right in. Okay, let's talk about the first basic deduction, and that is going to be the car deduction. Now, for whatever reason, a lot of business owners have a hard time understanding how to do the car deduction and what it really means. Now, the thing is, a lot of business owners already have the car, right? So the question becomes, well, how do I get that car as an asset under my business? And what if I already own the car? How does that work, right? So a lot of confusion going on regarding that sort of thing. Now, the thing to keep in mind is if you already own the car, it really doesn't matter, because you can actually expense the car under your business, whether you purchased it in your personal name or whether you purchased it in your business name, okay? So both of those actually work. So now the other thing, number two, what I want to really show you here is that you have to understand the advantages and disadvantages of buying it under yourself or your business. There's something called the personal debt to income ratio. So let's just say if I'm getting a loan I'm a lender giving you a loan, and I'm looking at, this is a car loan, and I'm looking at your personal debt. So if I'm buying it under my personal life, that means I have a high personal debt to income ratio versus a business debt to income ratio, okay? So that is something that you definitely have to understand. Okay, and there's really two ways to go about the car deduction. So the first way we're gonna look at is going to be the mileage-based approach. And then the other way is going to be the actual approach, okay? The actual method of expensing. And for the mileage is very straightforward, okay? So for the mileage, it's gonna be 56 cents a mile. So you can do 56 cents a mile, and that's one way to go about doing it. The other way is the actual, and that is based on expenses, okay? So all of the expenses associated with your car, and these can be almost unlimited, right? Because let's just kind of break them down. You have your car note, right? You have your car maintenance, right? You have your car insurance. So there's a lot of associated expenses. You have gas, you have car wash. So there's a lot of things that you're going to be using this is going to really add up. So now this is the expense-based approach. Now keep in mind that you can only do one or the other. You can either do the mileage or you can do the actual. You can't do both, okay? So let's just look on the actual side. If I'm expensing my car, one of the things I want to do is really understand how that expensing is going to work over time. So let's give you an example. Let's just say I had a $50,000 car. Ooh, that's expensive. Okay, and I'm looking at this expensing this over a 5-year period, okay? So that's divided by 5 years, okay? So this is going to be a method called the straight line depreciation method. So SL, that's straight line depreciation, okay? So this approach is going to allow us to divide. So it's easy math here, folks. So basically 50,000 divided by 5 years, that is going to be $10,000 a year. Easy math, okay? So this is what you're able to depreciate with the straight line method on the actual side, okay? Now, like I said, you can only choose one or the other, so keep in mind that these expenses can pile up either way. So just keep that in mind, and let's go to the next one. Okay, next up is the equipment expense. So let's just pop this in here. So equipment. Now, this is a fun one because you can deduct everything as pretty much equipment expenses that are associated with your work. So this means your cell phone, right? This means your laptop. This means your desk. This means anything associated with your business. So now keep this in mind. Your CPA may not really go into this level of detail with you because it's really not their job to go into the really deep details, because there's so many other things that you can write off, right? Your stationery, your office supplies, your light, your microphone. All of this is fair game, folks, right? Now, you may be saying, hey, Mark, well, I got a laptop back in 2020, but I started my business in 2023. Can I still write that off? Yes, you can. So the cool thing about that is when you go to write off your laptop, you're looking at what's called the fair market value. And that's super simple to find. You can actually research that, find it online, type in what's the fair market value of a laptop. Let's just say you paid $2,000 for it in 2020 and now it's worth $1,000. That's the fair market value. So you will be able to write off that $1,000, right? Now, the other thing to keep in mind is that you want to make sure that you're writing off everything that is an ordinary and necessary expense in the pursuit of income, okay? So that is going to be the key phrase that you really need to understand. But like I said, equipment expense is definitely something you want to have in your quiver as a small business owner. Next up, we have number 3, which is the home office deduction. Okay, now the home office deduction is pretty cool because effectively now a lot of folks are working from home, but some have already went back to the office. So sometimes you got to figure out, well, hey, what am I deducting for my office versus my home office? Okay, so let me clarify that for you. So as a business owner, what you're going to do is if you have work where you're working from home, you have a home office and you divide a certain portion of that home or rental into the place where you're actually working. So just to give you an example here, the way that works is you're going to take the square footage of your home or apartment, okay? And let's just say in this case you have your home is 1,000 square feet, okay? And your home office is going to be 100 square feet, okay? So basically it's simple math on that. So you divide 100 divided by 1,000, right? And that's going to be 10%. So that is going to be, you're deducting 10% as your home office, okay? And that includes everything. So things like your utilities, your gas, your electric bill, your cable bill, all that is included. So this is something that you definitely want to do. I see a lot of mistakes where people do not do that. And I mean, think about it. Working from home, you have a nice place carved out, you can actually deduct this. So not only the home office portion of it, but any of the equipment that's associated with it, all the stuff that you're using, right? So this coupled with equipment deductions is just the ultimate way to really save a lot of tax money. Okay, next up, let's talk about some advanced deductions. Now, if you are a small business owner, maybe you're still an LLC or S Corp or even a C Corp, you want to make sure that you're taking advantage of the maximum amount of strategies. And this is going to go beyond the basic deductions. And this is where we're going to start to get into some more advanced territory and really break down certain things because you want to keep your tax liability as low as possible. Okay, let's go ahead and dive in. So the first thing we're going to do is we are going to look at the first advanced strategy, and that is going to be payroll. And you're saying payroll, what about payroll? Isn't that simple? Well, not really. The thing about payroll is it's an advanced strategy because there's different things that you can do with it, and think of it as a lever in terms of your tax liability. So let's say, for example, you made $100,000 in your business, right? And you're trying to figure out, well, how much am I going to pay yourself? Let's just say you pay yourself 50% of that, right? So 100% is your net income, right? And that is going to be, so 50% of that is going to be $50,000, okay? And so that is $50,000 left for your business because this is what you paid yourself in W-2 wages, okay? Now, the taxable income is going to be the tax that is on the W-2, right? So for the payroll tax. So the $50,000 in W-2, that's going to be subject to self-employment tax, okay? And that is 7.65%. So the self-employment tax is effectively the Social Security and Medicare that you have to pay, okay? So that's 7.65% there, okay? Now, the remaining $50,000 in your business, that is going to be the, so that's the business income, okay? And the business income has what's called the QBI deduction. Okay, and this is the deduction. This is really a cool thing because you get 20% as a deduction for that income for your small business. Okay, let's just say, so for example, in this case, let's just say it's an S corporation. Okay, it's an S corp, right? Okay, so now here's the thing. Now this is where the advanced strategy comes in because, well, you can get, if you're paying yourself $50,000, that means you are getting 50. So the other $50,000 is subject to the QBI. So, well, maybe I should pay myself $60,000. But if you pay yourself $60,000, that increases your W-2, the percentage of the tax on that, right? So you probably don't want to go that way. But if you want to pay yourself less than payroll and more for the business, well, that maximizes the 20% QBI deduction that you're going to get. Okay, so for example, let's just say you ended up paying yourself $30,000 in payroll, so you have $70,000 left over for the business, right? So $70,000 income, that's going to be the 7 times 7.65. Sorry, for the 20% for the QBI, that is going to be $14,000 that you're going to be able to get back. Well, let's say, well, what if I went with that $50,000? Okay, well, that's just $10,000 that you're going to get for QBI based off of the QBI 20% for $50,000, right? So, well, going back to payroll, so why not just max out the income and really lower that payroll? Well, that may not be so good. Suppose you're looking for a loan, right? Well, you want to show that you actually have a lot of income to qualify for that loan. So you see how that's an advanced strategy there? Okay, so these are just a few things that you can do here, but just keep in mind that payroll is an advanced strategy because you have to factor in a lot of different things, and there's a lot of ways that you can really pull the lever on that. Let's dive into advanced deduction number 2, and that is going to be bonus depreciation. Now, the bonus depreciation is something that you hear a lot about on the internet, and really what they're talking about is section 179 of the Internal Revenue Code, right? So that's IRC 179, which states that you can write off parts of your assets. Now, what bonus depreciation does, it effectively allows you to take any asset that has a lifespan or a capitalized lifespan of 1 year or more, you can actually accelerate that and write that off 100%. Now you're asking, well, why do I want to do that? Well, instead of having to pay those taxes over a period of, a longer period, so items like larger assets like car, computer, these are things that, rather than having to write that off over a longer period of time, you can actually shorten that and deduct 100% in the first year if you want to, right? So that means, imagine being able to write off 100% of a car on that first year. And sometimes it could be a good thing, but other times it might not make sense, right? Sure, you could do it, but should you do it, right? Should you actually write off 100% over that first year period? So there's pros and cons of doing that, but basically the bonus depreciation method allows you not just to do the standard depreciation, but you can actually accelerate that depreciation in a way that you don't have to span over the typical lifespan of, say, like a 20-year cycle. You're basically able to do that in a much shorter time. Okay, now advanced strategy number 3 is going to be the Augusta Rule. And the Augusta Rule is actually pretty interesting because this is a tax deduction where people used to go to Augusta, Georgia for golf tournaments, and so many houses were taking advantage of having businesses pay them for that. Well, it wasn't fair because they would get taxed on it. So the Augusta Rule states that if you rent out your house for 14 days or less to your business, you do not have to pay taxes on that. Super cool, right? So this is an amazing strategy because it really allows you to rent out your home for any kind of activity. Now you have to document that well, right? Because if I'm an IRS auditor, I'm going to say, hey, what are you renting that out for? And why did you rent it, right? So you have to be prepared to ask those questions, to answer those questions correctly. But the Augusta Rule is definitely a more of an advanced strategy that you can use, but you definitely want to have your documentation in place for that. Okay, guys, we just covered some really interesting advanced strategies. So now what I want to cover next is the niche specific strategy. So just to recap, we covered the 3 advanced strategies. We talked about payroll, we talked about bonus depreciation, IRC 179, and we talked about the Augusta Rule. So the next up, these niche specific strategies are going to be for more advanced businesses that can really take advantage and go the next level, because if you are in real estate or if you are in investments, these are strategies that can really maximize your tax deductions year round. So even if you are in an extension period, you can still maximize these. So let's dive into the niche specific strategies. Okay, so the thing about niche specific strategies, these are going to be geared towards what I call sophisticated investors, right? So these are folks that are, there's ordinary investors and then there are sophisticated investors. The sophisticated investors are ones that they have investment portfolios, real estate, so passive income, versus the ordinary investor, which is just essentially a W-2 employee. So what I want to do here is I want to break down some strategies, niche specific for the sophisticated investor. And the first one is, one of my favorites. It is the cost segregation study. What is the cost segregation study? Well, this is basically where you are, let's just say you have a building, right? Building consists of, you have your building, but it consists of the building and then the land. So what we're doing is, for the cost segregation study, you're able to take what's called the rental use of your building. Now, how are you doing that, right? Because a building is something that you are able to rent. You can actually rent that out. So the building part of it, you can actually do this cost segregation study. And what that means is you're effectively writing it off. So you're writing it off as depreciation, right? So you do the write-off, and that's going to give you the depreciation. Now you're saying, hey Mark, that sounds like that bonus depreciation that you talked about earlier. Well, here's the thing. It's very similar, right? It's kind of like an advanced accelerated depreciation method, but the difference is you're writing off certain components of the building with the cost segregation. Now, this is something that you're going to need a professional to help you with, and the way that this is structured is basically divides it into whether it's a residential property or a commercial property. So let's just say for a residential property, these are typically depreciated over 27.5 years. That's a long time. Commercial properties are even longer. These are basically 39 years that the depreciation is done on it. So here's the thing. Well, with a cost segregation study, you're able to accelerate different parts on that a lot quicker, right? So you can really save on taxes by taking advantage of this strategy. So what are the things that you're able to accelerate that and do the cost segregation on? So let's look at them. So that's going to be the cost of different things like the flooring, right? Maybe lighting, different fixtures, appliances. These are all fair game for things that you're able to do the cost segregation on. So now here's the thing. So if you wanted to take advantage of this strategy, let's just kind of see how this pans out. So effectively, doing this, you're taking a tax loss for this strategy. So a cost segregation, let's just use an example here. Let's just say you take a loss because you had the cost segregation study done, and it was determined that you can write off basically $25,000 worth of this stuff here. So that's $25,000 loss, right? So you're asking me, like, why is that a good thing? Well, here's the cool thing. Let's just say you have $25,000 in income, right? From your business and business income, okay? This offsets this, right? So that's X'd out, and that becomes 0. So you've just eliminated your tax bill basically by taking advantage of the cost segregation. So it's a very powerful strategy, and this is one of the many advanced strategies that I talk about on my channel. Honestly, this is just the tip of the iceberg, but you want to be smart about doing this. Not everyone can do a cost segregation study. There are some DIY cost segregation studies out there that you can get for a few $100. Then there are some multi-$1,000 studies that you can do through professionals. There's a lot of great ones out there. So do your homework, do your due diligence, and when you speak to a tax advisor, make sure you get into those details on kind of like the pros and cons of what you can do with that. Okay, so the final niche specific strategy is going to be the defined benefit plan. Now, the defined benefit plan is one of my favorites because this is where you as a high income earner can actually put in quite a bit into what's called a defined benefit plan. So these are typically for these basically a large retirement account. Some folks can put in $50,000, $100,000, $200,000. So it's not like a typical 401k or IRA where you have maybe $6,000 for the IRA or up to 60-some thousand for the 401k. You can do massive amounts in here, and it's not for everyone. The defined benefit plan is going to be for more of a sophisticated person that has a lot of money that they can put in there, and there are some requirements, right? It depends on your age, how many years in business, certain demographics, certain employee makeup, right? So you really have to do an analysis, and you would work with a third-party administrator to go ahead and set that plan up. They're not free. There is a small fee associated, and there's many great companies out there that can do that. So this is one of the many strategies out there, and this is why I love tax strategy, and I hope you love it too, because you can save quite a bit of money, and there's so many different things and so many different ways you can go about doing it. Anyway, so thank you so much for watching this video. If you enjoyed it, definitely follow me, like this video so others can find it and find more information like this, and I will see you on the next video.